Mr. Dakshesh Kothari is a tax and financial consultant and the Managing Director and CEO of Ashutosh Financial Services Private Limited, which is an ISO 9001-2015 certified company with prominent presence in the field of financial services. He specializes in the fields of income tax, FEMA, trust laws, estate planning, and foreign tax compliances. On the financial front, he specializes in investment services and insurance advisory. He advises companies, trusts, high net worth individuals, and non-resident Indians across the globe on financial and tax and allied laws related matters. He is the director of Ashutosh Rubber Private Limited, which is a nationally acclaimed manufacturer of rubber and TPE products and a group company of Ashutosh Financial Services Private Limited. He is a trustee of various charitable trusts. He has been involved with a number of social service projects of Rotary Club and is a Paul Harris Fellow of Rotary International. He has been presenting analysis on the Union budget since last 15 years and also on various subjects of taxation and finance at various forums addressing doctors, businessmen, industrialists, taxation consultants, chartered accountants, company secretaries, NRI and postgraduate students of diverse branches on subjects related to finance, taxation and estate planning to make our society financially literate. His articles on financial subjects are regularly published in renowned newspapers like the Economic Times, Mint, etc. and also in magazines like Dalal Street. His interview was aired on ET Now as a mutual fund industry expert in the program named Swatantra, which is one of the most acclaimed investor education initiative of our country. He has also addressed a program dedicated to NRI on a leading Gujarati TV channel in Ahmedabad. He is a 360-degree versatile personality in the fields of taxation and finance, which makes him a unique and truly a one-stop solution provider for a wide range of financial and tax-related matters.
The topic today is on overview of NRI taxation, and that too with reference to the recent amendments. The last few words which has been added is with recent amendments. The reason is that there has been quite a few changes, especially in the way how non-resident Indians or non-residents for that matter are to be defined under the Indian Income Tax Act, which has come in effect from the 1st of April of this year, 1st of April 2020. The relevance of this topic in these times, I would just take a couple of minutes, is so much that all these years I am aware that people used to file their tax returns in the manner that even if he was a non-resident for several years, his return would be traditionally filed by his tax consultant or chartered accountant as a resident Indian accounts would be continuing and the return would be filed as a resident Indian, and he was never upgraded to a non-resident under the Indian Income Tax Act. Now, the implication is that if somebody says that I am a resident, then he is mandatorily supposed to disclose his foreign assets in his return of income. So now when a non-resident obviously would be having a lot of foreign assets and he says that I am a resident Indian and he does not disclose his foreign assets, then there will be a lot of complications and non-compliance that he is entering into. Then if somebody takes a call that I want to be really, which is a fact, that I want to put my real things in place, that I am a non-resident Indian. The moment somebody is a non-resident Indian, the Indian income tax return requires that you are supposed to quote your tax identification number, TIN number, in the tax return. So what happens is that if I am not disclosing my Indian income abroad and I am mentioning my tax identification number in the tax return which I am filing in India, then that would be an issue which will lead to certain complications. So now things have become quite tricky, and on the top of it, as far as non-resident Indians are concerned, they are supposed to disclose as to how many number of days that person was in India from the 1st of April to 31st of March. So all these requirements which are of certain fresh requirements or rather recent requirements which have come up in terms of disclosure in the return of income to be filed in India makes the topic of today much more and more relevant. With these words, we will start with the presentation proper. The first and foremost thing which somebody needs to understand is that what is the scope of taxability in India. So, how will a non-resident Indian be subjected to taxation and in respect of what incomes? So, that is the base of anybody's understanding of this topic. Now, in order to understand the scope of taxability in India, one should understand two simple concepts as to what is an Indian income and what is a foreign income. When it comes to Indian income, it is simple that income which is received, accrued or which has arisen or arised in India are Indian incomes, and foreign incomes are incomes which have not accrued nor received nor does it arise from India. Those are foreign incomes. This concept of Indian income and foreign income is very important for us to understand the scope of taxability in India. Now, when we go further, the Indian Income Tax Act has divided the residential statuses into three different buckets. One bucket is somebody who is a non-resident. The other bucket is somebody who is a resident, but the resident bucket is further divided into two parts, that resident could be a resident and ordinarily resident in India, or he could be a resident but not ordinarily resident in India, which is R but NOR. So, these are the three statuses that somebody needs to understand. In the further part of the presentation, I will clarify in a very objective, precise manner how somebody would acquire these statuses. Here, what I am trying to make you understand is what is the implication of each of these statuses. Say, I am a person who is resident and ordinarily resident in India. So, in my case, my Indian income is taxable in India. If I am earning some income abroad, which is a foreign income, on the basis of the definition which we saw in the earlier slide, my foreign incomes are also taxable in India, and if I was having any income from a business which was controlled from India or a profession which was set up in India, the income was accruing abroad, which is as such under the definition would say that that income has accrued, arisen and received out of India in a foreign country. But the fact if that business is controlled from India or that profession is set up in India by virtue of which I am receiving that foreign income, even that income is taxable in India. So, as far as resident and ordinarily resident is concerned, all these three kinds of incomes are taxable in India. So the scope of taxability when somebody is R and OR is absolutely 360 degree. Now when it comes to the status of resident but not ordinarily resident, the Indian incomes, because those incomes have been sourced from India, are definitely taxable in India. When it comes to foreign income, they are not taxable in India when somebody is holding at a R but NOR status. And if somebody is deriving an income which is as such a foreign income, but that foreign income is arising out of a business controlled from India or a profession set up in India, then that income in respect of R but NOR is taxable in India. Now, when it comes to somebody who is a non-resident, then Indian income in respect of that person is taxable in India, but foreign income or income from a business or a profession which was controlled from India is not liable for taxation in India. So, the endeavor of everybody who is not a permanent resident or a permanent citizen of India or a person who is not permanently staying in India has been or would always be that I want to be a non-resident under the Indian Income Tax Act, so that my foreign income and my income from a business which is controlled or a profession set up in India is not liable to taxation in India. So, this is the way the different residential statuses operate in India and the different kinds of income that would be liable to taxation in India in respect of each of these residential statuses. You might feel that this residential statuses, it sounds a little complex. Don't worry, in the coming slides, I will explain, as I said, in a completely objective, precise manner as to when somebody acquires these statuses. Now, issue arises as to what is the meaning of the term business controlled from India or a profession set up in India. There, the principle in respect of what does it exactly mean has been pronounced by the courts of law, the Supreme Court and the Bombay High Court in a particular decision which I have mentioned in this slide. The principle says that if a business is headquartered in or is located in a particular place, by headquarter, what we would mean is where the head of the business, the core decision making of the business happens, that place is the headquarter of the business. So, wherever the headquarter is present, that place would be the place from which the business is controlled, and if that place is India, then it can be said that that business is controlled from India. Presence and absence of somebody for a longer or shorter period of time doesn't matter. What is important is that where from the major decisions in respect of that business in that particular year were taken. This is important in case where somebody has got a business outside of India and that person is taking decisions in respect of his business or profession sitting in India. If the headquarter has shifted from one jurisdiction to another, say somebody was say outside of India and then somebody is in India, then the headquarters would get shifted on the basis of where the decision maker is available or where the decision maker is stationed. And the incomes which are to be rather taxed or not taxed in India would be on the basis of where the headquarters shifted and how it is to be maybe apportioned if the headquarters has moved from one place to another. Now, in order to apply that definition, of what would be the kind of the defining part that would apply in a particular circumstance, I have mentioned in the box above as to this definition applies to a citizen of India or a person of Indian origin who is outside India and who comes on a visit to India and has Indian income plus foreign income from a business controlled or a profession set up in India not exceeding 15 lakhs during the previous year. So, this definition which I have mentioned in the slide underneath is applicable to these kinds of situations. So, in the slides to follow, I have mentioned as to whom a particular definition applies. So, as I said, it becomes very objective and clear that where do I fall? If I am a citizen or a person of Indian origin who is outside India and comes on a visit to India and my income is less than 15 lakhs, then this is the definition of residential status or resident which is applicable to me. And that definition is quite simple, which says that if in a previous year means, as we all know, from the 1st of April to the 31st of March, that person was in India for 182 days or more. If somebody is in India for a period of 182 days and more, that makes him a resident. Otherwise, he is a non-resident. Now, the same thing, but if the income exceeds 15 lakhs. In the earlier definition or the earlier slide, I was talking about if the income is not exceeding 15 lakhs. Now, the same scenario, the same situation, but the income is exceeding 15 lakhs. If the income is exceeding 15 lakhs, an individual will be a resident if he is in India for 182 days or more. And now we need to be a little more concentrating on it, that the word is or. So, if you are for 182 days or more in the previous year, or 120 or more days in the previous year, and 365 days or more during the 4 preceding previous years, that makes somebody a resident in India. This is something which has been inserted from 1/4/2020. Earlier, the definition was quite simple, which was 182 days or more. Now, this part of or 120 days or more during the previous year and 365 days or more during the 4 previous years has been added, and the definition of somebody being identified or defined as a resident has become a more stricter, and more people will now fall into this definition. Now, what happens is that what would be the situation if somebody is in India for a period of more than 120 days but less than 182 days. In that kind of a scenario, that person would be defined as a resident but not ordinarily resident. All these years, under the Indian Income Tax Act, the basic definitions were whether somebody was a resident or a non-resident. Then from somebody being a resident, then as I said, there were two bifurcations, that person is a resident and an ordinarily resident, or a resident but not ordinarily resident. But this amendment after 1st of April 2020 has led to a scenario where somebody would be directly defined as a person who is a resident but not ordinarily resident. Then the next set of people who would to whom the definition of whether somebody is a resident or a non-resident would apply is that this definition would apply to an citizen, Indian citizen who leaves India for the purposes of employment, or an Indian citizen who is living India as a member of a crew of an Indian ship. For that person even the definition is quite simple, that if that person was in India for a period of 182 days or more, then that person would be a resident. Then this definition is for people who are persons other than, mind the words, this definition applies to persons other than. Which all persons? Is the citizen of India who leaves India for the purpose of employment, a citizen of India who lives as a crew of an Indian ship, or an Indian citizen or person of Indian origin who is outside India and comes to India on a visit to India. So this is a definition which is typically for a people who is a completely foreigner who doesn't have any Indian connections. That person would be called, or rather identified or defined as a resident if he is in India for 182 days or more during the previous year, or 60 days or more in the previous year and 365 days or more during the 4 preceding years. In order to find out that who is a person of Indian origin, the Indian Income Tax Act has defined, or rather has given its own definition as to who is a PIO. A PIO is a person whose parents or grandparents were Indians. That person would be a person of Indian origin. So this definition of PIO is a little different from what is the definition of a PIO or an OCI under FEMA. Then the last part, which is also a creation of the legislature in this current year, or which is applicable from the 1st of April 2020, and this definition of who would be a resident is going to have far-reaching implications on the taxability of so many of our Indians, and everybody of us needs to understand it very clearly and threadbare. This definition says that a person would become a resident but not ordinarily resident in India if he satisfies all these 3 conditions. Now let us see what are these 3 conditions. The first condition is that the person is a citizen of India. Now when I am talking about these conditions, keep somebody in mind who is in maybe a Dubai, that is our UAE, and even if that person has not come to India even for a single day in the previous year, but if he is satisfying these 3 conditions, that person would become a resident but not ordinarily resident. The first condition is, as I said, that person is a citizen of India. All the Indians who are staying in the Middle East, by and large, they hold Indian passport, even if they are staying in the Middle East, or maybe in some states in Africa. Even for 3 generations, they still hold Indian passports. So all those people are citizens of India. So that person is satisfying the condition number 1. Then the condition number 2 is that person is not liable to income tax in that jurisdiction or country for the reason that he is a domicile or a residence of that country. So, somebody who is staying in the Middle East, that person is not liable to tax because UAE doesn't have any income tax. They don't tax the income because they don't have a law to tax the Indian income tax. So, that person is also satisfying the second condition. And the third condition is that if that person is having Indian income plus foreign income from a business controlled or a profession set up in India exceeding rupees 15 lakhs during the previous year, then that person would be a resident but not ordinarily resident. And the tax implications would be the way which I stated or which I explained in the scope of Indian income. So, there could be so many people who would have never visited India in a particular year, but if they are satisfying all these three conditions, then those people would be classified as resident but not ordinary resident. Now, somebody would think as to what would be the implication of this. The implication of this would be that if that person sitting in India is controlling business or a profession which is outside of India and he has acquired a status of resident but not ordinary resident, despite the fact that that business is located outside of India, that income would be taxable in India. So, the reason why the legislature or the government bought this on the statute or made this as a law was the reason that there were so many people who were having businesses outside of India. They would stay in India for all this a lot of time in the year, and they would be having a resident but not ordinarily resident status, and they would be controlling business from India. So, the income of that business which is being controlled from India will be now taxed in India. And as I said that if somebody is a resident, then there would be two bifurcations, two buckets, resident and ordinarily resident. Somebody would become so if that person is a resident in India in at least 2 out of the 10 previous years, and he has been in India for a period of 730 days or more in the preceding 7 years. And if he is not satisfying that condition, then that person would be a resident but not ordinarily resident. So, the residential status, somebody the moment he is a resident, there would be two bifurcations, but as I said in the law in the present times, there has been a scenario where status of resident but not ordinarily resident is being inflicted upon or has been given to people who are straight away satisfying certain conditions. Now, we come to one very important part of NRI taxation, which is double taxation avoidance agreements. This is something that we need to know very clearly in order to get benefit of taxation when there is a scenario where somebody is a non-resident and liable to taxation in India. So, what is the basic reason why we have got this double taxation avoidance treaties? Now, I will just talk of a scenario wherein, say, I have my income in India, I am a tax resident in India, and I have incomes in, say, UK, Dubai and US. So, because I am a tax resident in India, my Indian income is obviously taxed in India because I am a resident out here, but because I am a resident, my Dubai income, UK income and US income would also be taxed in India, because as I said and I repeat that I am a tax resident of India, So, India would tax my global income. Now, in respect of my incomes of UK, US and Dubai, these countries would say that because these incomes have been sourced from our country, we will tax those incomes in our country as well. So, UK would say that because you earned this income from our country, we will tax it. US would do the same, they would also tax that income. Dubai would say, okay, we don't have income tax, so we would not be taxing. But at the end of the day, all my 3 plus 1, all the 4 incomes, 3 were foreign incomes for me and 1 is the Indian income, they all would be liable to taxation in India. So now, when I am filing my tax returns in India and paying tax on that entire income, my pain would be that I paid taxes in respect of these foreign incomes abroad and now I am being taxed once again in India. So, in order to eliminate or in order to mitigate this hardship, India has signed double taxation avoidance agreements with at least 90 different jurisdictions, or rather all the major jurisdictions or all the major countries of the world, and under that the incomes of somebody who is taxed in a particular jurisdiction would not be taxed doubly. So, by that what I would mean is that when my Indian income, my Indian income is taxed and my foreign income is also taxed in India, whatever are the taxes which I have paid in US, UK, they would be allowed as a set off while that income is being taxed in India, so that double taxation doesn't happen in respect of these incomes. Over and above that, in order to see that trade, business, investment between different countries and jurisdictions get better, different countries, when they negotiate between each other, they enter into this double taxation avoidance agreements and give some concessions, that even if the conditions of the local law are a little more harsher, those conditions can be softened under the DTAA. And the principle is that when a non-resident to whom the DTAA is applicable, he has a right to choose whatever are the conditions which are beneficial to that non-resident, he can pick and choose. So, if there is a provision under a DTAA which is beneficial to him, he can opt for those provisions, or if he thinks that the provisions of the Indian Income Tax Act are beneficial, then he can opt for those provisions. So, practically what happens is that the treaty or the double taxation avoidance agreement and DTAA would override the principles of, or rather the provisions of the local law or the Indian Income Tax Act. So, in order to illustrate, I have put forward before you that the tax rate under the India UAE DTAA on dividends is just 10%, whilst when that non-resident, if that income or that dividend income is subjected to taxation under the Indian Income Tax Act, it is 20%. Interest under DTAA with UAE would be taxed at 12.5%, and interest under the Indian income tax will be taxed at slab rates. So, if somebody is a UAE tax resident, then he can claim benefit of DTAA, and I would like to draw special attention of so many of the people who are viewing this, that so many of the non-residents are unaware of this, and they don't take advantage which they are legitimately, which is available to them, by which they can claim the benefits of DTAA of that respective country where concessions are available. One more interesting concession which I would like to draw attention to when it comes to India UAE DTAA is that if somebody who is a UAE tax resident, by that what I would mean is that if that person's stay in UAE is more than 183 days in a calendar year, not our previous year, I am talking of the calendar year, which is 1st of April to 31st of December, then capital gains would be taxable in respect of immovable assets, movable assets of a business, shares, but not incomes or capital gains from mutual funds or bonds. So, when it comes to any UAE tax resident, howsoever big that long-term capital gain or short-term capital gain would be, that person would not be liable to pay any capital gains in respect of that Indian mutual fund sale incomes. And that is true even when bonds are sold. So, if somebody is able to claim or can definitely claim the benefits of DTAA, then these incomes would not be liable to tax. So, what I would mean is that any non-resident, he should always check what are the benefits which I can avail under the particular DTAA which is applicable to my country. I have mentioned a couple of court decisions which have supported the view which I have explained to you. Then another interesting thing when it comes to the DTAAs is that DTAAs would lay down certain rates of tax. Say, as I said, in the UAE DTAA, it is say 10% on dividend, 12.5% on interest. But when it comes to India, there would be surcharges and cesses that would be levied or would be added to that income. But if somebody is paying tax in accordance with a DTAA, then that is the amount which is the final rate of tax. So, if the DTAA says it is 10%, then 10% is inclusive of all surcharges and cess. That non-resident is not required to pay any tax, any cesses or surcharges further. And this view is endorsed by the two court decisions which I have mentioned. So, whenever you are compiling your tax affairs and you are taking benefit of DTAA, the rate of tax mentioned under the DTAA is the final rate of tax. In order to claim benefits under the DTAA, what somebody needs is a tax residency certificate of that particular jurisdiction. So, if I am saying that I am a tax resident of UAE, then I need a tax residency certificate of UAE, and that tax residency certificate has to be obtained every year. This TRC with form 10F and a declaration have to be submitted along with the while filing the return of income and to somebody who is making deductions of tax at source. Now, the provisions and formalities for people who are returning to India and who were erstwhile NRIs and now they are in India. The moment somebody returns to India, if somebody was holding an FCNR on an NRE account, that NRE account can be held till maturity. A non-resident Indian is allowed to hold it. But when it comes to the interest of these NRE accounts, till the time the NRE account or FCNR account, somebody is of the status of R but not OR, only then that income would be exempt in case of FCNR account and in case of RFC account. RFC accounts are what we discussed in the last presentation, returning NRIs can go for a resident foreign currency account, and that would only be exempt if till the time somebody is holding that R but not OR status. But the moment that status becomes R and OR in respect of that returning NRI, that income would be liable to tax. And in case of NRE account, that NRE account, the moment somebody comes to India, that NRE account should be redesignated as a resident Indian account, and the incomes in respect of that NRE account, whether savings or FD, would be liable to taxation in India, because it is available, the tax exemption is available only to people who are non-residents under FEMA. If you are returning to India, then you cannot avail that exemption. As far as the taxability of NRE and FCNR term deposits are concerned, the returning NRI can claim deduction, or rather a lower or a concessional rate of tax at the rate of 20% till the time the NRE or FCNR deposits mature. Then one common difficulty which arises, that how do you compute the taxable income when different financial years are followed in India and abroad. So what happens is that India would be following a financial year starting from the 1st of April to the 31st of March, while as a foreign jurisdiction, maybe a US, would be having its financial year, or the tax year as it is known there, is 1st of January to 31st of December. So what we need to do is that we need to segregate the transactions from 1st of January to 31st of December in the bank statements and investment statements, and incomes or transactions in accordance to those dates need to be provided to the non-residents, so that the Indian incomes could be appended along with the US income when that person is filing his or her US tax returns. So if the transactions are voluminous, then somebody can enter into the transactions into a computerized accounting software and run a start date of 1/1 to 31/12 for the US records, and 1/4, 1st of April to 31st of March for their Indian affairs. So whenever we have done transactions in India, the incomes would get segregated, and we will be able to add the incomes, or rather will be able to comply when we are filing our US tax returns. So when it comes to the incomes, yes, we saw that there is the bifurcation on the basis of the date, but when it comes to taking credit of the taxes which have been paid in India, and as I said that they are available under the DTAA, which is existent between say an India and US, then whatever are the taxes which have been paid in respect of incomes between 1st of January to 31st of March, and not interest or penalty, whatever are the taxes in respect of that income from 1st of January to 31st of March, we would have already filed our tax returns, because their year ends on 31st of December. Before that, we would have definitely filed our tax returns. So whatever are the taxes that we have been paid are deductible when the US tax computation is made. But in respect of incomes which are from the 1st of April to the 31st of December, the Indian return would be pending at the time when the US return or US tax compliance is being prepared. So whatever are the taxes which have been paid in respect of that incomes may be TDS towards the final tax liability. If that tax which was paid till 31st of December, but it was refundable, then it is not supposed to be claimed as a deduction in US. But if it is paid towards the final tax liability in India, then that tax is deductible while computing the US tax returns. Now, reporting for foreign tax compliance. The reporting part of foreign tax compliance is quite important. There, say for instance, as far as maybe a US, Australia or UK is concerned, their financial years are different. Their tax, the dates of filing the tax returns are quite different. So, we need to keep this thing in mind and provide all those non-residents who are located abroad and having their financial affairs in India on the basis of the financial year which they follow in order to include that income in their returns of income. So, what is the data that somebody should supply to them? The data that somebody should supply to them is that what has been the income date wise in the respective financial year. The word is respective. So, if somebody is in Australia, then it is 1st of July to 30th of June. So, according to that respective financial year, income date wise details should be supplied to them, name and address of the source, then conversion in that respective foreign currency as per the prescribed reference rate. So, if that income is earned on that particular date, then whatever is the exchange rate, which is the prescribed reference rate from where it should be obtained, which website, that has to be the manner in which we need to supply information to the non-resident, which he can compile while he is filing his tax returns abroad. Then whatever are the TDSs, which we call in India as TDS, they call it as a withholding tax, or advance tax, which they call it as prepaid taxes. Whatever are such taxes paid, we need to convey to them and give details that against these incomes which we need to disclose. These are the taxes that we have paid, and those taxes, as I said, that it has to be towards the final tax liability in respect of those incomes. Then along with that, normally all the major jurisdictions require that what are the assets which are held by the non-resident in India, then what were the investments that were made in India, and maybe a jurisdiction like US would require that what was the closing balance of the mutual fund units at the end of the year, and that too in a prescribed format. So, just for simplicity and give an indication as to what is the manner in which data should be supplied to non-residents so that they can compile their tax affairs in a very efficient manner is something which we have provided here for just a reference. The reason why we need to provide these details very clearly to the non-resident is that now the world has become more and more compliant. All non-residents are very keen that they should be disclosing their Indian incomes abroad, and one of the roadblocks for them for not investing abroad is that they find the compilation of their tax and financial affairs very cumbersome. So, if we are able to provide them the data in a manner that it is very much understandable or manageable, then things become quite easy. This is a case of a typical NRI who would be having certain incomes in India, and those incomes need to be disclosed and given in detail as to what are the incomes, so that their life becomes easy when the tax compliance is happening. Now, we will go to the various rates of Indian income tax and the TDS, which is or rather rates of withholding tax or TDS, which are applicable to non-resident Indians. The first and foremost thing which I would like to clarify is that in India, who is required to file a tax return? Anybody who has an income which is exceeding 2.5 lakhs, which is the minimum threshold, that person is required to file a tax return. But this 2.5 lakhs is supposed to be calculated before the deductions under chapter 6A, that is our ATC, ATD and all those kinds of things, and the exemption provisions of capital gains. So, after the exemption provisions of capital gains or after chapter 6A deductions, which are all these section 80 related deductions, my income falls below 2.5 lakhs. No, then I need to file a tax return, because I need to consider the income before giving effect to such deductions. Then if somebody wants to claim a refund, his income is as such not liable to tax in India, but if he wants to claim a refund, then he needs to file a tax return in India. Otherwise, that refund would not be available on the taxes which have been withheld, which is our TDS. Then there are three categories of persons in whose case filing of return is mandatory, wherein if in a current account there has been deposits, not necessarily cash deposits, any kinds of deposits in a current account in excess of rupees 1 crore, electricity expenditure in whose name the bills have been, electricity bills have been issued, doesn't matter. If the aggregate expenditure on electricity is more than 1 lakh of rupees during the year, or if that person has incurred travel related expenditure in excess of 2 lakhs in the previous year, then that person is liable to file his tax returns in India, irrespective of the fact whether the income is taxable or not. Then the rates of slab rates are as I mentioned in the slide, and the important thing which we need to note is that when there are special rates of tax for non-resident Indians for taxation, then the basic exemption limit would not be applicable. So, if there is a special rate of 10% or 20% in respect of a particular income, then that basic exemption limit of 2.5 lakhs would not be available. So, I have got an income which is liable to be taxed at 10% worth rupees 10 lakhs, then I need to pay 10% 1 lakh by way of tax. I cannot claim that the 2.5 lakhs by way of the exemption, basic exemption which is available. That I will be able to claim only in respect of incomes which are taxed at the slab rate. Now, if somebody is receiving incomes from salaries, then the taxation levy would be at the slab rates, and the withholding tax or the TDS will also be at the slab rates, and the asterisk mark on the rate part at the top column is that these rates are subjected to surcharge and cess. When it comes to rental income, it is taxed at the slab rates, but after a deduction of 30%, which is a standard deduction which is available in let out properties, the withholding tax is 30%. In case of remuneration and interest from a partnership firm, it is taxed at slab rates, the withholding tax is 30%. Then in case of share from a partnership firm, the tax rates it is exempted from income tax. So, there is no levy of tax, and hence there is no TDS as well. When it is business income, it is taxed at slab rates, and the withholding tax is or TDS is 30%. Sale of immobile property including agricultural land located within specified area. So, it is basically within the city area, agricultural land or immobile property is located. The holding period is 2 years to qualify for long term capital gain. If it is long term capital gain, then it is taxed at 20% with indexation, and period is less than 2 years, then it is short term capital gain and it is taxed at slab rate, and the TDS rate is 30%. Sale of listed shares, long term, 1 year is the period, then it is taxed at 10%. To the extent of 1 lakh, it is exempted, but if it is below one year, it is short term, it is taxed at 15%, and identical are the rates for TDS. Then equity oriented mutual fund is the same as listed equity shares. Short term is 15%, long term is 10%. First 1 lakh is exempted, and the same are the TDS rates. In respect of unlisted securities, unlisted shares, unlisted non-equity based mutual funds. So, all the debt funds and all the quite a few hybrid funds, they are unlisted, and they would be liable to tax at the rate which is short term capital gain, which would be without indexation and straight away at the slab rates. When they qualify for long term capital gains, then it would be taxed at 10% without any indexation, and so would be its TDS or withholding tax rate. Listed non-equity based funds. By listed non-equity based funds, what I would mean is that if there is an FMP which is listed, then it would fall into this category. There the short term capital gain is it would be added to the income, and the 3 years is the holding period to qualify for long term capital gains. If it qualifies for long term capital gains, then it would be taxed at 20% with indexation, and identical are the rates for TDS and withholding tax. Then listed securities, corporate bonds and debentures, holding period 1 year, below 1 year it will be short term, taxed at slab rates, TDS will be 30%, beyond 1 year then capital gains with taxation of 20% and indexation, or 10% without indexation, whatever is beneficial to the person who is filing, who is declaring that income. Interest income or NRO deposits, private deposits, small saving schemes will be at slab rate and TDS would be 30%. Dividend income from shares 20%. Resident Indians pay dividend income tax at the rate which is slab rate, but when it comes to non-residents, it is just 20%, which is the flat rate of tax, and so is the rate for TDS. Dividends from mutual funds is for residents, it is added to the regular income which is taxed at the slab rate, but for non-residents it is 20% and 20% is the withholding tax. These are the rates of surcharge when it comes to different brackets of income between 50 lakhs and 1 crore, 1 crore and 2 crores, 2 crores and 5 crores, 5 crores and above. And on the top of all these surcharges, we need to add health and education cess to these amounts, and the surcharge on capital gains which is listed equity or equity oriented funds, it is maximum is 15%. So, if there is a gain on sale of listed equity shares or equity oriented mutual funds, then this slab rates of surcharge would not be applicable. There would be 15%, that would be the maximum rate of surcharge that would be applicable. The way this surcharge is to be levied is that when I am supposed to make a tax deduction at source, I need to look into that what is the kind of income that I am paying. Say, if there is an income on sale of immovable property and the capital gain, the income component on the sale of immovable property is say 40 lakhs, then I will fall in the category of 50 lakhs, below 50 lakhs. So, I will be only subjected to 4%. But if the income component is 60 lakhs, then it would be 10% surcharge plus 4% higher education cess. Section 195 is the provision under which tax deduction of source is to be made in respect of non-resident Indians. There, the provisions of section 195 say that the payer could be any person. So, even if that payer, so if I am paying any income as an individual, as an HUF, as a firm or a company, whosoever pays any income to the non-resident Indian and that to any sum, then it would be subjected to TDS at the prescribed rate. If the non-resident thinks that my income would not be subjected to TDS or rather withholding tax at a particular rate, then he can approach the income tax authorities under section 195(3) for nil TDS, or the payer, whosoever is the resident Indian, he can approach the income tax authorities and in a prescribed in a non-prescribed format, means where there is no format which is prescribed, he can approach the income tax department with the details and ask for the determination of the amount on which TDS is supposed to be made. This can be done by the payer who is the resident when he is making payment to the non-resident. The non-resident can also, under section 197, approach the income tax department for a nil TDS or a lower TDS certificate, so that taxes are deducted in accordance to whatever is the real income or the tax liability. Whenever there is an income which is not liable to tax, that income is tax free, section 195 does not apply, because the provisions say that any income which is liable to tax. So, if that income is not liable to tax, then it is not subjected to any TDS, because that income, as I said, would in any case is exempted. Then one very important thing when it comes to TDS is that as far as section 195 is concerned, that any person responsible for paying a non-resident Indian any other sum chargeable under the provisions of this act deduct income tax thereon at the rate in force. The word where I would like to draw your attention is that sum which is chargeable under the provisions of the act. So, whenever somebody is making any payment, say on purchase of any immovable property, I am making a payment to a non-resident, then wherever I can fairly ascertain or where I can determine that this would be the income which will be chargeable to tax, then I need not deduct on the gross amount the entire consideration, but I need to make deduction on that income which is a sum which is chargeable to tax. There the courts have clearly said that there are provisions under the law to obtain a certificate of lower rate, but that does not mean that the deductions have to be made on the gross amount. It has to be made only in respect of incomes which are chargeable to tax. And these things have been affirmed, what I am saying, on the various decisions which I have cited. And in respect of immovable property, there is a specific decision which I have mentioned, which could be useful in respect of transactions with non-resident Indians. Incomes which are completely exempted, NRI account interest, PPF account interest, agricultural income, or gain on sale of agricultural land which is located where the aerial distance from a town or a city, as I have been mentioned in the slide, is beyond those limits which has been mentioned, then that gain on sale of that entire agricultural income proceeds is completely tax free. Share in the partnership firm is also tax free. So, all these incomes which are completely tax free will not be subjected to any TDS under the Indian Income Tax Act for non-resident Indians. Now, one of the important things which have been in active discussion since last at least 4 or 5 years has been FATCA and F-bar. So, we will have a brief understanding as to what is this FATCA and F-bar. FATCA basically, why was it introduced? US, as we all know, is a country which has been made up of people who have rather the best of the brains, who have migrated and settled in US and have been earning money since all these years and have been quite successful for all these years. What was happening was that when somebody is a US tax resident, then he would be deriving income in US, and because of his affection towards his motherland, may it be India, Asia, or maybe South America or whatever, they would be having their investments and business interests outside of US as well, and would be having income outside of US. So, under the resident rule which I discussed at the time when I was talking about the DTAA, anybody who is a tax resident of a particular country, he should be disclosing the income of that country, while as the foreign income in the country where he is a resident. So those US tax residents should be offering to tax their global income in India, in their US. But what was happening was that the US, so many of the US tax residents were paying tax only on the US income, and the income outside of US was undisclosed. So in order to check this FATCA and FBAR came into existence. Under that, what happened was that the US government signed agreements with more than 80 different jurisdictions of the world, that includes India, or let me say that the 80 jurisdictions of the world were supposed to sign those agreements under FATCA, that you will be supposed to share the financial information of the US tax residents from your country to us. And alongside that, the US government made a provision that when you are filing your tax returns, you also need to file a form on FATCA, and that FATCA form would be tallied, or rather cross-checked, with the information which is available from those respective jurisdictions. So this is the way they wanted to check that foreign incomes of US tax residents does not go untaxed, or they are aware of whatever is happening. There was also a provision of FBAR, which is reporting of foreign bank and financial account, wherein the US tax resident was supposed to file 114 form, where if somebody has got financial interest or signature authority in any account outside of US, and the aggregate value of all such foreign accounts exceeded rupees 10,000 at any time during the calendar year, then those accounts need to be reported under FBAR. When it comes to FATCA, the US taxpayer has to file Form 8938 on foreign financial assets, and the US tax authorities would get information from foreign financial institutions. That means our banks and all those institutions which are handling the tax affairs of the US tax residents, and that would be cross-tallied, and the US tax authorities, as I said, would try to figure out that how to whether these incomes have been rightly disclosed or not. So this was just a brief overview as to why FATCA and FBAR was introduced, and what is exactly something which is supposed to be done when it comes to FATCA and FBAR in a nutshell. Then I would like to roll out some tax planning tips for non-residents in India. The non-residents in India can avail deduction under Section 80C the way the resident Indians can in respect of the different kinds of investments. They can make investments or rather they can pay health premiums under Section 80D and claim the deductions of it. They can claim a deduction under Section 80G for the donations which have been made by them. Then they can also get a deduction under Section 80TTA on the interest on the savings bank account to the extent of 10,000 rupees. And that would actually or practically will be applicable for NRO accounts, because NRI account balances are anyways tax free. Then one thing that non-resident Indians need to keep in mind is that they will not get the deduction or the benefit of senior citizen or super senior citizen related enhanced taxable limit. So for a super senior citizen which is above 80 years, the taxable limit for if somebody was a resident Indian, then it becomes 5 lakhs. So that would not be available to non-residents. Then rebate under section 87 capital A of 12,500, which effectively makes income to the extent of 5 lakhs completely tax free, that would not be available to non-resident Indians. So, we need to keep in mind these two things while we are planning our tax affairs. Then deduction under section 24 for the housing loan interest which has been paid is available to the extent of 2 lakhs, and loss can be claimed and it can be set off against other incomes. Then if somebody is intending to stay in India for a long period of time, say somebody wants to stay in India for say 8-9 months, then the simple planning that they should be doing is that they should split their stay in India in 2 financial years in India, so that they remain non-resident in both the years. So, one part, say 3-4 months can go into the before 31st of March and 3-4 months can be after 31st of March. If both the stay fall in 1 year, then that person would attract those definitions which I laid down in detail, then that would make him a resident, which is not something which is advantageous to him. Then he can claim deductions of section 54 EC by making investments in capital gain bonds. He can also make investment under section 54 and 54F. While you have some capital gains and you invest in a residential house, or you sell one residential house and invest in another residential house. Another thing which all the non-residents should be a little particular about is that if I take you back to the definition of what is a foreign income and what is an Indian income. The Indian income is the income which is accrued, arise or received in India. So, if an income which is as such a foreign income, but if it is just received in India, it will become an Indian income and liable to tax in India. So, if I am having some interest income or some pension income, I should see that those incomes are received outside of India and then brought to India by way of remittance. Remittances in India are completely tax free. Then if somebody is holding balances or fixed deposits in NRO account, they should take the benefit of the $1 million scheme. Somebody can convert, or rather the NRO account balances can be converted into NRE account balances and transferred to NRE or FCNR accounts, thereby making the interest income from those accounts completely tax free. Wherever it is possible, wherever the situation or the scenario permits, one can go for taking the advantage of HUF as an entity, because non-resident Indians who are Hindus can definitely claim the benefit of Hindu undivided family as a legal entity, and an NRO account of an HUF where all the members are non-residents can be opened. Then when it comes to keeping assets in India, if the incomes in India are liable to tax, but then as I said that the global income is supposed to be taxed in a foreign country. So, I need to include my Indian income where I am filing my foreign tax affairs. So, there what I can do is that if I have got some trusted close relatives in India, then I can might as well keep those incomes in the names of those trusted relatives, and then it would not be subjected to taxation in my country where I am taxed on my global income. And the interest can be protected by a specific will. In the later part, the last part, I will exactly explain how we can take the benefit or the advantage, or some people really take the advantage or benefit of it. Then assets held by the HUF, they are, whether they are liable to tax in foreign country or not, it depends upon the country in which that person is a non-resident. When it comes to US, then there might be a scenario where it might get clubbed with the individual income. Then for non-residents who have not disclosed their US income or rather Indian income in US, then they can take a call and go for streamlined filing compliance procedures, where there is a distinction between a willful and a non-willful in compliance, and they can become compliant for the part of the assets and income which they have not yet disclosed in India. Now, this brings me to the last part of my presentation, which is 4 slides, which I said that gives a picture as to how people can plan their tax affairs while making investments in India in a tax friendly manner. So, we look at case 1. So, what practically happens is that funds from abroad will travel to an NRI account. Then from the NRI account, we will make investments in India, and those incomes from investments would be subjected to taxation in India. And the moment there is a taxation in India and there is income in India, it would lead to taxation and compliance abroad as well, because as I said, the non-resident needs to disclose the Indian income in his country where he is a tax resident also. Now, say if the non-resident has got some savings and incomes from sale of assets, those monies will go to an NRO account, then it will go from that NRO account, it might go to investments in India. From those investment incomes, there would be income from those investments, then it would be taxation in India and tax compliance abroad. So, this is the standard thing which happens in respect of all the non-residents. Now, the improvised version of this case 1, which I detailed out, could be that funds from abroad can be transferred to India as gifts to parents. The point which one needs to understand or keep in mind is that then the ownership of those funds would get transferred in the name of the parents. Then investments can be made in the name of the parents. A NRI can be a nominee in respect of those investments, but as it is a settled law that a nominee is not the owner of the assets, he is merely a custodian or a trustee of the assets which he would receive on demise of the account holder. So, a specific will in respect of those investments is something which is advisable of whatever amounts which are held by the parents. Then incomes, then investments can be made, incomes can be generated, taxation would be there, but there would be no taxation abroad for the reason that those investments are owned by parents. Later on, then the redemption of this, after the redemption of these investments, at whatever date, whatever time thereafter, gifts can be given to NRIs or if in case, if there is a case of a transmission, if there is a sad demise of the parents, then in any case the nomination is in favor of the NRI. So, the transmission happens in respect of the NRI in his favor. Then those balances would get transferred to the NRO account on redemption of those investments, and under the $1 million scheme, one can repatriate those investments from the NRO account outside of India or transfer to the NRE account. The same thing happens in case 2, wherein whatever are the amounts which are received on sale of assets in India from the NRO account, gifts can be given to the parents. Then investments can be made with nomination and a specific will, taxation only in India, no taxation abroad. At the time of redemption, gifts can be given to NRIs. Transmission in case of death of the owners of the assets, and balances in the NRO account. From the NRO account, $1 million scheme, monies can be transferred. So, this brings me to the end of the presentation. Whatever I have been saying in this presentation, these are my personal views, and whatever has been discussed or whatever I have said in this presentation should not be relied upon without due professional advice. And wherever any citation of any legal citation I have made, I have mentioned the details as to whatever I have relied on. Thank you so much.